Yogah Karmasu Kaushalam.
Hi, welcome to the 11th session in our course HRM for non-HR managers. In the previous session, we discussed employee induction and onboarding. In this session, we are going to discuss different components of employee compensation, pay and perquisites, as well as various rewards and incentives. In the process, we will explore the factors that help determine the employee pay rates, various considerations in determining the pay, as well as the rewards and incentives. This session will focus on the management aspect of compensation. However, compensation practices are regulated by law in many countries. The session after this will cover the legal provisions that every manager should be aware of, whether qualified in the field of law or not. Employee compensation includes all forms of pay to employees on account of their employment. It has two main components: direct financial payments like wages, salaries, incentives, commissions, and bonuses, and indirect financial payments like employer paid insurance and vacations. There are two basic ways to make direct financial payments to employees against the work done by them: based on time and based on performance. Time-based pay is still the foundation of most employees' pay, which is calculated on hourly, weekly, monthly, or yearly basis. The second direct payment option is to pay for performance. For example, piece rate ties the compensation to the amount of production or pieces of finished goods the worker turns out. Translators, for example, get paid on the translation work done per page. Telecallers may be paid per call made every day. There are several factors determining the design of any pay plan: company strategy and policy, as well as the considerations of equity, law, and unions. In today's session, we will address the first two. The compensation package, including wages, incentives, and benefits, should advance the firm's strategic aims and help achieve its competitive strategy. Various laws also specify things like minimum wages and benefits. We will present in the next session the pay-related compliance required by law in India. Compensation scenario in India is interesting to look at, as you can see on your screens. KPMG's annual compensation trends survey in India report brings its findings from 263 companies across 19 sectors of the economy. It says that the average performance pay projection has increased from 15% in 2016-17 to 15.4% in 2017-18. The highest variable pay as a percentage of employees' cost to the company, or CTC, is reported by the banking and financial services sector, and the lowest by the energy sector, that is oil, gas, coal, and power. Many organizations are shifting towards competency-based pay, which takes a step further from performance-based pay. You may remember that competencies are observable and measurable behaviors of the person that make performance possible. Experts variously call this pay competence, knowledge, or skill-based pay. With competency-based pay, an employee in a lower level job who is capable of performing higher level work gets paid at a higher level, even if he or she doesn't have to do the higher level work according to the current job description. You may be wondering why companies might be using competency-based pay. Companies adopt competency-based pay because of three reasons. First, competency-based pay encourages the employees to develop those competencies which help their company achieve its strategic aims. Secondly, paying for measurable competencies provides a focus for employers' talent management process. Thirdly, traditional pay plans can backfire if the goal of the organization is to create a high performance work system. The whole thrust of these systems is to encourage employees to work in a self-motivated way. In such systems, the manager wants employees to be enthusiastic about learning and moving among jobs. One problem managers often face is that whether paid on the traditional basis or competency basis, the employee compensation still remains confined to pay grades. Grades often induce rigidity in compensation, and sometimes it becomes difficult to increase an employee's pay more than the maximum limit of a grade without promoting them to the next grade. A solution to this problem is offered by broadbanding the compensation. Broadbands of compensation reduce a complex pay structure into just a few bands, where the difference between minimum and maximum pay can be as wide as 100%. You should remember that fixing the pay of senior executives is different from the pay fixation for other jobs lower in the hierarchy. Executive compensation is usually based on the ability to lead in a competitive environment and many other related competencies and strategic considerations. Stock options is an important part of executive pay, although it is not limited only to the top executives. Usually, executive pay is determined and monitored by compensation committee as per the law. Now we move to discussing perquisites. Perquisites are the emolument or benefit attached to an office or position in addition to salary. These may be non-cash or cash equivalent benefits. They may also include reimbursement of employees' expenses or obligations by the employer. For example, the subscription to professional journals or magazines or salary of the driver for the car. Perquisites are also referred to as fringe benefits. Section 17, subsection 2 of the Income Tax Act of India defines perquisite including 5 elements. One is the value of rent-free or concessional rent accommodation provided by the employer. Second is value of any benefit or amenity granted free or at concessional rate to the employees. Third is any sum paid by the employer in respect of an obligation which was originally payable by the employee. Fourth is any sum paid by the employer for any annuity or assurance on the life of the employee. Fifth, of course, is the Income Tax Act also would consider the value of any other fringe benefit as may be defined from time to time. We now move to the discussion of incentives. Incentives represent the employer's promise to pay the employees an additional reward contingent upon employees' target performance. For example, if an employee can stitch 2 outfits per day in a normal course, it may be considered a base or target performance. Beyond that, for the first outfit over and above the target may attract an incentive which may be a percentage or an amount. Or all of a firm's employees may be promised to be given incentive if the organization expects to earn a gross profit margin of 15% but actually earns 20%. We will now present individual employee incentive and recognition programs, sales compensation programs, and team and organization-wide incentive programs. As you can see, some incentives are tied to individual performance, while some others can be earned based on the performance of the group, each member of which may be paid equal amount of the incentive. Individual employee incentive systems tied to the performance of individual employees are known as individual incentive plans. These plans depend on a category of workers for whom they are designed. Under this plan, mostly a certain pay rate is guaranteed and the rewards represent additional compensation based on performance beyond a defined limit. Individual wage incentive plans may be offered to all 3 categories of personnel: production or blue collar workers, white collar workers such as salesmen, and managerial personnel. For example, in Surat, which is a city in Gujarat, the firm Hari Krishna Exports conducted the ceremony and gave cars to 600 of its employees. The chairman of the firm, Savji Dholakia, said, as reported by Indian Express, "This year we have shortlisted 1600 diamond polishers working in our company who performed well, adding to the growth of the company. We wanted to give them incentives. Thus, whoever was interested in the car will receive cars, and the rest will be given fixed deposits and flats. This is an effort to motivate them to perform even better in future." Merit pay as an incentive is any salary increase the firm awards to an individual employee based on his or her performance. It is different from a bonus in the sense that it usually becomes part of the employee's base salary. A bonus is a one-time payment. Although the term merit pay can apply to the incentive raises given to any employee, the term is more often used for white-collar employees and particularly professional, office and clerical employees. Merit pay is the subject of much debate. Those who advocate it can't see any reason in giving any incentive to the employees which is not tied to their merit, while the opponents argue that the appraisal processes themselves are unreliable. If the appraisals are unfair, so too will be the merit pay you base them on. Similarly, supervisors often give most employees about the same rating and raise, either because of a reluctance to alienate some employees or to give everyone a raise that will help them stay even with the cost of living. The solution is not to avoid merit raises, but to make them more effective. Among other things, this means establishing effective appraisal procedures and ensuring that managers tie merit pay award to performance. Making incentive pay decisions for professional employees can be challenging. The professionals draw good compensation because of their knowledge and are usually motivated to receive recognition for excellence. However, it is unrealistic to assume that people like the engineers, system analysts, and programmers at Microsoft and Google work only for professional gratification. Few firms therefore work harder to maintain competitive incentives for professionals. For example, Google reportedly pays higher incentives to engineers working on important projects. Dual career ladders refer to offering growth plans to professionals switching their areas of expertise. Higher salary and bonus sometimes brings the employees out of their functional areas such as engineering into general management. Not all professionals may want such paths. Therefore, many employers institute dual career paths, in other words, one path for the managers and the other for technical experts. The latter offer professionals such as engineers the prospect of using advanced technical skills and earning higher pay without switching to management. Non-financial rewards and recognition are as important as the financial rewards to the employees. Studies show that recognition has a positive impact on performance, either alone or in conjunction with financial rewards. Recognition programs are one of the several types of non-financial rewards. The term recognition program usually refers to formal programs such as Employee of the Month programs. Social recognition program generally refers to informal manager-employee exchanges such as praise, approval, or expressions of appreciation for a job well done. The monetary value of non-financial rewards is often low, as they are most often symbolic. Some of the most used rewards to motivate employees include gift certificates, special events, small cash rewards, merchandise incentives, and email or print communications, among others. There are many ways in which the managers and supervisors can motivate their subordinates without depending on the organization's incentives and rewards. 3 guidelines are available to them from the goal setting theory. The first guideline is make sure that the employee has an achievable goal and that he or she agrees with it. Psychologist Edwin Locke and his colleagues have found that specific and challenging goals lead to higher task performance than specific but unchallenging goals or vague goals or no goals. Second, recognizing an employee's contribution is a powerful motivation tool. Studies and theories like those of Maslow and Herzberg show that recognition has a positive impact on performance either alone or in combination with financial rewards. Third, the manager can use social recognition such as compliments as positive reinforcement on a day-to-day basis. Commission plan is one more type of reward. Commission plans pay salespeople for results or performance. An example of a commission plan is when salespeople are paid 20% of every sale they make. Commission plans tend to attract high-performing salespeople who believe that their effort would produce rewards. The organization incurs them only if the sales are made. Employees find such plans easy to understand and compute. Poorly designed commission plans lead to part of work being neglected, manipulation, and resignations. Team incentive plans are initiatives designed to encourage and reward exceptional levels of professional achievement. It is a way for business owners to boost overall productivity and earnings while simultaneously rewarding employees for a job well done. The objective of team incentives is to encourage group goal setting, collaboration, and teamwork. Profit sharing plans allow all or most employees to receive a share of the firm's annual profits. Profit sharing is a team-based incentive plan in which company pays employees a percentage of company's overall profits. Profit sharing builds a sense of ownership among employees and encourages greater team performance levels. Employees know that the better their performance, the better the business's financial picture and the higher their own potential cash rewards. There are several types of profit sharing plans. With current profit sharing or cash plans, employees share in a portion of the employer's profits quarterly or annually. In cash plans, the firm simply distributes a percentage of profits, which is usually 15% to 20% of profit, as a share to employees at regular intervals. With deferred profit sharing plans, employer retains a part of the employee's dues for payment at a later date. Some consider pension as a kind of profit sharing. We will discuss pensions in the next session. Scanlon plan is a profit sharing program in which employees share in pre-established cost savings based upon employee effort. Formal employee participation is necessary with the Scanlon plan as well as periodic progress reporting and an incentive formula. Scanlon plans have 5 basic features. The first is Scanlon's philosophy of cooperation and a sense of ownership in the company. The second feature of identity means that the company must articulate its mission or purpose in order to focus on employee involvement, and employees must understand how business operates regarding customers, prices, and costs. Competency is the third feature of a Scanlon plan, which demands a high level of competence from employees at all levels. The fourth feature of the Scanlon plan is the involvement system. Employees present improvement suggestions to the appropriate departmental level committees, which transmit the valuable ones to the executive level committee. The latter then decides whether to implement the suggestion. The fifth element of the Scanlon plan is the sharing of benefits formula in the interest of transparency and ethical conduct. Other gain sharing plans are also a part of the employees' reward system. A modern version of the Scanlon plans is gain sharing plans. Gain sharing is an incentive plan that engages many or all employees in a common effort to achieve a company's productivity objectives, with any resulting cost savings gains shared among employees and the company. There are 8 basic steps in implementing a gain sharing plan. First is establish general plan objectives such as boosting productivity or lowering labor costs. Second is choose specific performance measures such as labor hours per unit produced. Third is decide the portion of gains employees will receive. Fourth is decide the method for dividing and distributing the employee share of the gains. Popular methods include equal percentage of pay or equal shares. Fifth is choose the form of payment, usually cash. Sixth is decide how often to pay bonuses. Firms tend to pay based on financial performance measures annually and on labor productivity measures quarterly or monthly. Seventh is develop the involvement system. The most commonly used systems include steering committees, update meetings, suggestion systems, and problem solving teams. Eighth is implement the plan. In an earning at risk pay plan, employees agree to put some portion of their normal pay, say 6%, at risk if they do not meet their goals in return for possibly obtaining a much larger bonus, say 12%, if they exceed their goals. Employee stock ownership plans or ESOPs are company-wide plans in which the employer contributes share of its own stock or cash to be used to purchase such stock to a trust established to purchase shares of the firm's stock for employees. The firm generally makes these contributions annually in proportion to the total employee compensation. The trust holds the stock in individual employee accounts and distributes it to employees upon their retirement or other separation from service, assuming the person has worked long enough to earn ownership of this stock. Effectiveness of incentive plans is different for different organizations. However, they may share common features. First is effective incentive plan addresses the employee's motivation, establishes a clear relationship between employee effort and parameters of employee performance, and focuses on that part of the employee's work which they can control. Second is effective incentive plan links the incentive with the organization's strategy. Next, the incentive is linked to behavior that is critical for achieving strategic goals. Third, it establishes a clear link between employees' effort and their performance and between their performance and reward. Effective incentive plans offer rewards which the employees value. Fourth, effective incentive plans use a well thought out and complete set of performance standards. Fifth and final, effective incentive plans are scientific in the sense that they contribute to performance, help gather evidence, and analyze the effects of the incentive plan over time. Such an approach allows evaluation and future improvement. With this, we come to the end of this 11th session in the course HRM for non-HR managers. We have discussed various kinds of compensation, perquisites, incentives, and rewards. In the next session, we will discuss the legal considerations not to be missed while deciding the pay plans for the employees. See you soon. Until then, goodbye.